Hello. All right, let's do our chapter 2 video. So this is the very first chapter that we cover in managerial accounting. Chapter 1 just kind of talks about the differences between financial and managerial. So I didn't include that chapter for the online class. But just to kind of summarize that, just so you guys know, basically managerial is focused on managers and how to help them make decisions using accounting. So we don't do a lot of debits and credits and journal entries. What we focus on is how to use accounting information for decision-making purposes. So this whole chapter, chapter 2, is about different kinds of costs and different kinds of costs that you experience. And so costs can be classified in a lot of different ways. They can be variable or fixed. They can be direct and indirect. They can be product and period. So we will learn how to classify different costs and also how to write a cost equation. So how to estimate what your costs are going to be and come up with a cost equation for that. So the way these videos work, for those of you that are new to me, is you guys either pull up the notes and fill them in with me, or you print them and handwrite them. And so I learned from the last class that you guys prefer to have like smaller videos rather than like an hour-long video. So I will make like 3 smaller videos for this chapter probably. So I'll kind of pay attention to my time down here and try to cut myself off a couple times and start over with a new video, just so you can watch them in little bites rather than big bites. So again, this chapter, it looks like it's about 10 pages, and we're going to fill in blanks as we go. So that's kind of how this works. So starting off, just a review from financial accounting. There's actually 3 different kinds of businesses. There's merchandising, manufacturing, and service. And so back in financial accounting, we focused primarily on merchandising businesses. And so we bought stuff and then we sold it to other people. So we had revenue and COGS, and we went through and did things like that. We could have also done service businesses in financial, and we did some, but in general, we did a lot with merchandising businesses. So purchases a product and sells to another. So basically, you're just buying something and reselling it. So managerial accounting, we're going to focus on manufacturing businesses. So instead of buying stuff and selling it to others, we are going to make it. So purchases parts and creates a final product and sells it. That sounds good. So we create a product. So what we're going to do is we're going to take pieces and parts and we're going to make a bicycle. We're going to take pieces and parts and we're going to make a car. We're going to take pieces and parts and we're going to make bracelets. So we're going to do different manufacturing environments. And so when I'm doing manufacturing environments, I try to picture me standing like looking down at a factory and I see all the things moving around. And we'll talk about that a lot as we go. So when you're talking about a factory environment and we're talking about the cost to make a product, we can use bicycles in this first chapter. I talk about bicycles a lot because I know the parts. So that's kind of lame, but we're in general going to talk about different kinds of products all the way through. But let's start with a bicycle in general. So in a manufacturing environment, what we're going to say first is that one of the most important costs is direct materials. So direct materials are the pieces and parts involved in your product. So these materials can be directly traced to the final good. I don't know how to word it. It doesn't really matter. On my blanks, it's just something like to kind of make you guys stay active with me. So these are materials that actually appear on the final product. So as we're looking at products, we can say, you know, like what are the different pieces involved? So we can look at a bicycle and we can see handlebars and a frame and pedals and gears, and all of those things make up the actual finished good. So you can actually see those items on the bicycle. All right, so next is direct labor. So this is the cost of employees who work directly on the product. So, so I guess it would be the cost of like anything involved with how you pay those employees who are actually working on the product. The key though is these people have to actually touch the product. Okay, so their main job is to touch it. So they are putting the bicycle together. They are attaching things and welding things or whatever they're doing to it. But their job is actually physically putting the product together. You can directly trace the labor cost to the finished good. So if we're talking about bicycles again, these are the people that are working on the factory floor that are actually putting things together. It makes me think of my dad. My dad worked at a brick plant, and so they manufactured brick. So the direct materials would be clay and water and dye. I don't know. So that's why I talk about bikes. And then the direct labor would be the people who were actually putting the bricks together. So there's a kiln, and at the end of the kiln, you move the brick and you put it in stacks on pallets, and those pallets get shifted to other areas of the business. Out in the pits, there's people digging for clay, probably not like that, probably not like digging like this, but they're using forklifts and different things to move product, bulldozers, and to move everything. Those people are direct laborers. My dad was not a direct laborer. So we'll talk about what he actually did at the plant next. So the next category of costs. So these two make sense. These two are logical. They make sense. So direct material and direct labor are things that you can look at the bike and see the pieces. You can watch the making of the bike and see those people putting it together. So the next item is overhead. And so overhead are all other costs incurred in, and I'd actually like you to like highlight this or something to make this word seem very important in making the product. So overhead is not the president of the business or the marketing team, because they do not make the product and their costs are not involved in making the product. So all other costs incurred in making the product. So what we're talking about here is, what other costs do we need to be able to make a bicycle? Well, we need electricity to run the machines. We need supervisors that watch the people making the product. We need my dad. Okay, my dad's a good example of overhead because his job was maintenance of the equipment. And so he maintained all of the equipment at the brick plant. And so if the equipment isn't maintained, then the equipment doesn't work and you can't make the product. So equipment maintenance workers, supervisors, anybody that works in the factory that's not directly touching it, those are going to be considered overhead. So these are categories of overhead. So overhead is harder to understand, so I kind of break it down in categories. So we could have something called indirect materials. And so notice that it says indirect rather than direct. So indirect materials are not traced directly to the finished good. So my little brother, I went to visit him over this fall break, and he works at a body shop. So he's a manager at a body shop. And so before you paint a car, you have to sand a car. I don't know a lot, but I think I kind of know that. So sandpaper before you paint a car is not direct material, because when you look at the final product, you can't see sandpaper on your painted vehicle, hopefully, unless you really messed up. So sandpaper is a necessary material, but it's not direct material. So it's necessary to make the product, because to be able to paint a car, you got to sand it. So that would be an example of an indirect material. Also clean. Oh, did you try again? My phone or my watch is talking to me. So also things like changing the oil in the machines. That's material that's needed in the factory, but it's not on the finished good. When you look at bicycles, you don't see like the oil that you use to change the oil in the machine on the side of the bicycle. Okay. So cleaning supplies, different things like that are all indirect materials. So the cleaning supplies to clean the bathrooms in the factory, that's necessary to make the product. Doesn't feel like it, but you got to have bathrooms for your employees that are making the products. And so cleaning supplies for the bathroom involved in the factory would be considered factory overhead. All right, so the next category is indirect labor. So indirect labor would be people like my dad. People that do not touch the actual product, but are necessary. So my cousin Justin, he worked in the factory and he was a direct laborer. So my cousin Justin's job was to pick up the bricks, like they were like the bricks that have like the 4 holes or whatever, and he would pick them up and move them. And so he was just moving them all the time. Like this would be a lot more impactful if I was in a room with you guys and you could see me, but you see me in the little box, right? So he'd pick up the bricks and he'd move them, pick them up and move them. And so I thought he would really have good core muscles, like his abs would be like super built, right? Because he just all day would pick up bricks and move them. That job is a very temporary job for people because their backs go bad. Like your back can't handle that kind of movement very long. But he was a direct laborer, but my dad, as the maintenance worker, was an indirect laborer. Custodial type people, supervisors, the factory personnel department, the people that hire people in the factories. So Tor's son's girlfriend works for like Mars, like that makes like M&Ms, I guess, probably, and Mars bars. And she hires people to work at the factory. And so she would be considered an indirect laborer of the factory. And then general overhead are things that you guys would think of as overhead. So you have to have lights in the building to be able to make the goods. You have to run the machines with electricity. You have to depreciate the machines, property taxes and insurance on the factory, everything that relates to the factory. But if it doesn't relate to the factory, it will not be it won't be an overhead. Okay. So direct material and direct labor combined are often referred to as direct costs. So direct labor and direct material are called direct costs, while overhead is an indirect cost. So direct cost you can directly trace to the actual product, while overhead is indirect. So that's just a definitional type thing. One of the items up at the top that you have to classify between is direct and indirect. And so direct is direct material and direct labor. Indirect is overhead. So just one of our definitional things. Okay, so the next page, we have more definitional things. This chapter makes me a little bit crazy because there's a lot of definitions, but it works out fine. We're going to put numbers to it and it'll make a lot more sense. So our product costs. So product costs are defined. We have product versus period. So our 3 product costs are direct material, direct labor, and overhead. So these are the product costs, also called manufacturing costs. So product costs are direct material, direct labor, and overhead. Those are the 3 product costs. Okay. So direct material and direct labor combined, we refer to them as direct costs. They're also called prime costs. So that's another term for them. So we could call them prime costs. So prime is just another word to describe the direct material and direct labor. And so when I think of prime, I think of primary. They're the main ones. Okay. So they're the main costs. And the direct labor and overhead combined are called conversion. And so the way I remember that is that basically when I have like pieces and parts, I want to convert it into a finished good. So to convert it, I need laborers, and then I also need overhead like electricity and factory machines and supervisors and to be able to create that finished good. So conversion, to convert it into a finished good. So I want you to notice that direct labor is in both. So it's a prime cost and it's a conversion cost. So that's kind of tricky. And so like as a multiple choice question, you might see something that says something like, which of the following is a conversion cost? And it would be like A, B, C, D. Well, conversion costs can be direct labor or overhead. And it might say, which of the following is a prime cost? Well, that could be direct material or direct labor. But it might say, which cost is both prime and conversion? And that would be labor, okay? Because it falls in both categories. So prime versus conversion isn't mentioned here as one of our classifications, but it's one way to classify costs. And so, but all of our prime and conversion are considered product costs because this whole little table here, this little picture here is all product costs. And so when we look at product costs, the other side of product costs are called period costs. And period costs have nothing to do with making the good. That's the distinction. Period costs have nothing to do with making the good. Okay, so if it's dealing with making the good, then it's a product cost. It's either direct material, direct labor, or overhead. But once it's made and you're ready to sell it and advertise it and stuff, that moves to period costs. So period costs are either selling or admin. So those are the two kinds of period costs. And so selling costs are things like advertising, commissions, depreciation of the salespeople's vehicles. All those things would be selling costs. And then administrative, this is like the corporate headquarters. So this is where, like, for Walmart, it would be in Bentonville, Arkansas, and it's where the president of the company is. Most of the administrative costs of our university, a lot of them are in Davis Hall, because that's where Dr. Carey is and her admin assistant and different people like that. A lot of our administrative costs are also in Sumter, where you find the HR people and the accounting people. So we are not a manufacturing business because I don't create a product. I am more of a service, I guess, because I am educating people. But as far as selling versus admin costs, these are called period. And so our product costs are going to be recorded as assets because you're going to create an actual good, and that good will eventually be sold to customers. And then period costs are going to be expenses. Okay, so I'll walk you through like product costs as we make a bicycle. If it's an asset while you're making it. And when you own one and you're getting ready to sell it, it's an asset. But when you sell it, it moves to COGS because it's sold, cost of goods sold. So we'll walk through that. So here's a little sample question to kind of like when I'm teaching this in class to get me to stop and let them like think through this and answer these questions. And so you guys can pause me and try to answer each of these as product versus period. So go ahead and you can pause the video and you can think about this. Okay, so manufacturing equipment depreciation. Since this deals with making the good, because manufacturing means it's part of the factory. So since it deals with making the good, then this will be a product cost. So a product cost has three choices. Our product costs are direct material, direct labor, and overhead. Those are our three product costs. So of the three, and you didn't have to do this, but this is just extra to help you with your homework. So of the three, depreciation for equipment, would it be direct material, direct labor, or overhead? So direct material are the actual pieces and parts. When you look at the final good, so if I'm looking at a pair of scissors, if this is what I'm selling, I can't see depreciation on it. I can't be like, wow, look at all that depreciation on there. I can see the blades and the handle and things like that, but I cannot see depreciation. So it's not a direct material and it's not a direct labor. It is definitely overhead. So I'll just put overhead. Okay, so this one says property taxes, but it says on corporate headquarters. So if this said property taxes on the factory, then it would be a product cost and it would be overhead. But it says on corporate headquarters. Corporate headquarters is like Bentonville, Arkansas. So that is a period cost. And so period costs could be either selling or admin. And so this one would be admin. Again, you didn't have to specify admin. I'm just doing that extra for help for homework later. So direct material is definitely a product cost. It's part of creating the product, and it's direct material. The three choices of product are direct material, direct labor, and overhead. Electrical cost to light the production facility. That's another word for the factory. We can call it a production facility. We can call it the industrial park. So we can call it just a factory, which would be nice because that's basic. So if it deals with the factory, it has to be a product cost. And specifically, electricity would be considered overhead. And then sales commissions is a period cost because that's a selling cost. Okay. All right. So the next thing we're going to do is we're going to actually draw a picture on this page. But first, I want to walk through the three different kinds of inventory on the balance sheet. So there are three different types of inventory. So the first one will be called raw materials. And so raw materials are the pieces and parts. And so we can actually put that here if we want. Pieces and parts. So, and it also could be like supplies, pieces and parts, supplies, that kind of stuff, like cleaning supplies and things, lubricants for the machines. All of those can go in raw materials. So raw materials is a physical place. So when I'm in class, I'm looking across the room. I always pick the people on one side of the room and I'm like, all right, you are in charge of the storage room. When I think of raw materials, I think of the storage room, the place where all of our goods are sitting, like all of our pieces and parts. And those goods are assets. If I have, 50 sets of handlebars and 100 tires and 100 pedals and all these different pieces and parts, those are assets to me because eventually I'm going to create a bicycle and I'm going to sell it. So the next kind of inventory is called work in process. You can use the word process or progress. I see both in textbooks. And so we call it WIP. So that's the abbreviation that we use for it often. And so WIP is work in process. And these are bicycles that are partially completed. They're not done yet. They're on the factory floor, sitting there, a frame, no tires, or a frame and handlebars and gears and everything, but waiting to be painted. Okay. So this is items that are not quite done yet. Okay. And those are assets to us. So it's another asset on our balance sheet because these goods will eventually turn into a finished good and we will sell it. And so eventually we'll get money for these. And so our last item is finished goods. And so finished goods are completed bikes ready to go. All right. So these bikes are not sold yet, but they're sitting on our, in our factory warehouse, ready to be shipped to customers. And so they are an asset to us because eventually we'll sell them to customers and then we will get money. Okay. So the next thing I want to do is a little refresher, and this is just to remind you about T accounts. And so what I want you to do is I want you to draw an inventory T account, and you can draw it right here because there's an open space right here. I do not want you to draw it down here because we're going to draw a picture at the bottom of page 2. So up here is fine. And I want you to draw a T account for inventory. And it has a beginning balance of 1,000. I want to point out to you that inventory is an asset. So assets have a debit balance, ADE. Okay. So assets, dividends, and expenses are debits. They have a normal debit balance. So what I want you to do, and I'm going to go out to Excel to do it because I want to draw on the screen. And so I'm going to also draw an inventory T account. So I am out in Excel and I'm going to go to view and get rid of my grid lines so you guys can just see this. And I am going to draw a T account for you. So when you draw a T account and you're doing it in Excel, which you guys don't have to do it in Excel because hopefully you guys are just drawing a T, right? Because hopefully you printed your notes because it's kind of easier. So I'm going to merge and center 2 cells and draw a bottom border. And then I'm going to highlight a few cells and draw a right border. So now I have a T. And so what I'm going to do is I'm drawing the inventory T account. And because I merged those, it'll center it nicely. And so there is the inventory T account. And so an inventory T account is an asset and it has a beginning balance and an ending balance on the debit side. Okay. So okay. So what we'll do is we'll draw a line along the bottom to show that the ending balance is down here. So now I have to look at the numbers because I'm not sure what the numbers said. It says, so I can see both. If your inventory balance at the beginning of the month was 1,000 and you bought 100 during the month, if you buy inventory is going up and then you sold 300. So if you sell inventory, it leaves inventory. Okay. So one of the things I usually point out when I'm teaching this in class is that when I first started teaching at Friends, I was teaching in the business management program specifically, and they were people who were not planning to be accountants. And they told me they didn't want me to use debits and credits. They just wanted me to talk about accounting in general, but not really refer to debits and credits. And so I really had a hard time with this inventory chapter when I was teaching the topics because I use the T accounts to explain it because it makes it a lot easier. And so what I did was I just called them ins and outs. And so it actually works in this chapter to do that. So when you buy inventory, you start at 1,000 and then in, out. This 100 came in because you bought it and this went out because you sold it. So then they want to know what the ending balance is. Well, if you started with 1,000 and you bought 100, then you're at 1,100 minus 300 gives you 800. So we know, because we took financial accounting, that you would do 1,000 plus 100 minus 300 to get an ending balance. This side is the bigger side, so that's where the balance is. So I'm going to give that 800 a double bottom border. Okay, top and double bottom border. And then, because I can, I'm going to try this. I'm going to take a picture of it. Okay. And then I'm going to come over here and I'm going to paste it. I'm going to just put it right here. And then I'm going to format the picture. Format the picture. I don't really know how to do this. I just wanted it to get like, oh, I think I just need to do like save, send to back. So, here we go. And so I'm going to do it in front of text like that. And then I'm just going to drag it up here. I'm also going to make it smaller. Oh, I just made myself bigger. Okay, I did not mean to do that. Sorry that this is taking a second. I apologize. Okay. All right. So now that's up there and it's out of my way. Sorry, that took me a little bit longer than I wanted it to. Okay. So that's just me drawing a little T account. Life is good. Okay. So the next thing I want to know, so the answer here is 800. Okay. And now I have my answer up there too. Okay. So if your inventory balance at the beginning of the month is 1,000, you bought 100, you sold 300, what's the ending balance? And so now what I want to do is I want to draw a picture down here. And I want your picture to look exactly like my picture. So what we're going to do is we're going to draw 4 T accounts across. So I want you in this space that I've given you to draw 4 T accounts across. Okay. So I'm going to come over here to blank Excel and I'm going to do that as well. So I'm going to, view, get rid of my grid lines, and then I'm going to draw 4 T accounts. So I will go ahead and do that quick. I want you guys to do it as well. And so I'm going to draw 1 T with a border on the right. And then I'm going to draw another one, and another one. I just copied and pasted those across. Okay. So now we have this one and we're going to label it raw materials. And so you can abbreviate that RM. This one, we're going to call it WIP. Okay. So you can write out work in process if you want. And that's called WIP. And then this one's going to be called finished goods, FG. And this one's going to be called COGS. And I'll make it bigger so we can see it better. But what we've got is we've got 4 T accounts. And you wrote this at the bottom of your page 2 notes where I had that open spot for you. And so what we're going to do is we're going to make ourselves a little cheat sheet to understand basically where these things go. All right, so we're going to have a beginning balance and an ending balance. And I'm going to draw a line across because raw material is an asset, assets are debits. So at the beginning, we're going to have some raw materials, and then we're also going to have an ending balance. Double underline it. So what I've got is I've got a raw material account where I'll start with a beginning balance and an ending balance. What I want you guys to think of is that this is like the storage room. This is where all the pieces and parts are hanging out. So we can have a person in charge of that storage room, and they're the ones that let people bring in stuff and take stuff out. So like FedEx and UPS and stuff will drop off goods to us, and then we will give them out to the laborers that are going to be able to create the goods. Okay. So if somebody says, I need to make 20 bikes, and I'll be like, you need 40 tires. Here you go. So we're going to like give out the materials as we need to. As we buy materials, we're going to put it in here. And so purchases will go in here. And then as we use up material, it will come out. So just like when we did the inventory T account that started off with 1,000, we bought 100, we got rid of 300, and we ended with 800. Same idea. So the number that comes out of here will be called direct material. And direct material will then move over to WIP. So there we go. So I drew a little arrow to take the direct material over. And so WIP is another physical place. I like you guys to think of them as physical places. And so this is the factory floor. This is where we're actually making goods. So we will have a beginning balance and we will have an ending balance. We will draw a line across and we will double underline my ending balance. And then three things come in here. Three things come in here. Those three things are direct material. And so that number will come directly from over here. So that number literally shifts over. Okay. So then the other two things that go in here are direct labor and overhead. These three things are the product costs. They're called the manufacturing costs. So our three manufacturing costs were direct material, direct labor, and overhead. Those three product costs. And those three costs go in to WIP, in meaning debit. So they go in there. And then as we complete goods, we shift them over to finished goods. Okay. So as we complete them, we'll shift them over to finished goods. So when they get all done, they leave the factory floor and like picture it as a bicycle. And maybe we've got somebody that does quality control and that person has to ride the bike over to the warehouse. The warehouse is where all of our completed bikes hang out until we sell them to the customers. And so our warehouse, when we get there on January 1, we'll have some bikes just hanging out ready to go. We'll have a beginning balance and an ending balance. And then they're completed. And then as we sell them, they leave here and they go over to COGS. So these goods shift over. And then these goods shift over. Okay. So I can draw arrows. Uh-oh. No. Here. Shapes. And draw an arrow coming over. And then I can draw another arrow coming over. Well, that one's kind of off kilter. Okay. I'm going to double underline this ending balance. One thing to point out, COGS does not have a beginning balance. COGS is an expense. Cost is an expense. COGS is an expense, so there's no beginning balance, and that's because we closed the red ones. So remember from financial accounting, you close the revenues, expenses, and dividends. RED get closed, expenses get closed. So COGS get closed, so it does not have a beginning balance. These are assets. Assets do not get closed. Assets carry forward to the next day. So we do have beginning balances and ending balances in our asset accounts, but not COGS. Okay, so it's just its answer is right here. That's the answer. Okay, so you could draw a line and you could say it has an ending balance, but it'll just be based on what's sold. And then you close it. All right, so let's take this. Let's make a picture. And we'll come over here and we'll put that picture right here. Okay. So we'll make this as little as we can. Littler. Okay. Okay, so that is our product cost flips. So the costs go from raw material into WIP, into finished goods, and then into COGS. So, okay. So the next thing we're going to do is we're going to do an actual example with this, but I'm going to stop the video and then I'll pick up with the next one. So, all right. Thank you.